Good morning, everybody. Hey, welcome to Friday. Man, it's hard to believe. October 23rd. We have 1 week left. Next week will be the last week of October. So I'm glad you joined us today as we get ready to look at the markets, some earnings that have kicked in, because we got a pile of earnings today. Some good, some not so good. We'll talk about those. Not a lot to talk about on the macro, on the macro side of the economy, but next week is loaded with a lot of big numbers coming in as far as what the economy looked like in the third quarter of this year. So again, I want to thank you for joining us. Hey, Dave will be with us here in just a minute. Remember, there's only one thing that you can control in your portfolio, and that's the amount of risk that you have. That's why I developed the Financial X-ray. Give me a call, 863-382-0037 to schedule your financial X-ray, or go to my website, statlerfinancial.com. There's a link there where you can schedule a time for us to talk. Dave will be here in just a moment.
It's been really weird of the futures overnight. One of my tech guys are calling it Groundhog Day all over again, and you start really wondering if that's not the case. Let's go downtown Sebring to the offices of Statler Financial Services. Phillip Statler standing by. Phillip, good morning. How are you?
Hey, good morning, Dave. I'm doing well today. I hope you are too, as we finish up the third and next to the last week of October.
Absolutely. It's kind of a doldrums for government data coming out, so it's a good thing we're in the middle of earnings season, because there's a slew of them. Getting into the tidbit news levels and the like, it was the final presidential debate last night. Reviews generally, and you saw part of it. I have to go to bed early enough to the point where I have to watch the highlights on the news the next morning. By and large, it was much more civil. I'd made mention we got on the phone or before we went on the air that I was kind of surprised not to see oil stocks tanking, because basically the exchange that caught my eye the most, because basically Trump accuses Biden of wanting to put the oil industry out of business, and Biden's reaction in a nutshell is, no, we want to evolve them out of business by funding all kinds of green energy ideas. I kind of half expected to see all the energy stocks tanking this morning pre-market.
Yeah, no such luck today, and I think because we're seeing a little bit, actually a bump in oil prices this morning. It's about where it was yesterday when you and I talked, but it's up from where it closed.
Yeah, and over 40 isn't a bad thing on the per barrel price. I'm mostly being flip on that because it was actually a relatively well-behaved debate last night. The Chicken Littles are out. I've got an analyst on one of my tip sheets saying that it's looking like we got the possibility of another 2001 valuation crash in the tech stocks again. Is that Chicken Little, or is this a realistic threat?
Well, if you look at what tech's done, who really knows at how those things really end up being valuated, right? So, I mean, the NASDAQ's already down this week about almost 1.8%. Obviously, it's had a heck of a run for the last 12 months, being up almost 42%. So, could it give back 10, 15, 20% and still be in good shape? It could. It's all going to depend upon how this economy continues to spin and whether it moves up or down.
Absolutely. We kind of alluded to that the other day on this conversation. Yeah, NASDAQ, I always watch the price earnings ratios, and on the Dow, 15, 18-time price earnings ratios are considered almost conservative. The Standard & Poor's is a little more than that. You start getting into NASDAQ, you talk to 35, 40-time price earnings ratios. Yeah, those stocks tend toward being growth-oriented, tend toward being riskier. Whether or not we're looking at another tech stock crash like 2001, heaven forbid that happened, because it cost a lot of people a lot of money back then, didn't it?
Well, it did. And let's think back to what that was. That was a lot of the dot-coms, and they weren't generating any revenue, even hardly. They were definitely not making any money. So that's not where we are today. A lot of the tech firms right now, especially in that NASDAQ 100, are profitable companies. And they're just the price to earnings ratio is just higher than the other two indexes.
Absolutely, and a lot of it is because of the fact that they're tending toward being growth stocks, and that means they trade at a premium. But yeah, it's been interesting watching since the dot-com crash happened as these companies have evolved. They've gone from being complete flyers. You buy a company that loses its shirt, and you still pay $1,000 a share for it. As the company matures, they start holding them to the standard. You've got to make money, and you've got to have a reasonable multiple. And yeah, I don't see another complete dot-com crash coming on. Although your point's taken, some of the companies might need to be called to performance standards based upon what happens with the economy overall.
Yeah, and so I don't think we're in that predicament because let's face it, when we talk about .coms, a lot of those .coms went to zero, went to a tenth of what they were worth or what they were valued at the beginning. So I don't think that when we look at the NASDAQ that we're really in that same boat.
Probably not. A correction's always a possibility, but I'm glad to hear that level of reassurance. I mentioned that we got Groundhog Day going on again. Hope and fear and keeps going back and forth as to whether or not we're going to get a stimulus, and it looks like some of that's affecting the futures. The Dow is going through about 140-point swing since midnight last night. It cratered for a while. It now went back up by about 140 points from where it is. But the way the week is ending so far, unless we have a big turnaround today, the main indexes are going to lose a little bit this week, aren't they?
They are. It's going to take better than where we are right now for them to end up in the green for the week. And based on what you and I've seen this week, I think that's kind of unlikely.
Yeah, these morning green numbers don't tend to hold up half as well as we wish they would. Earnings season continues. Do we have some signs that we might have reason to go up based upon how the companies we trade are doing?
So, Dave, today is a story of tech and finances, and then we weave in a little restaurant and a little of toys. So how's that for a menu?
Sounds like a recipe for stew.
So let's start with Intel. Intel was a favorite child for quite a while. However, third quarter, not so good for them. Basically, their earnings were in line with expectations. Their revenue actually beat by a little bit, but in one of their KPIs, one of their key performance indicators, they saw a major decline, and that's in their data center group. That revenue declined by 7%, and that was a big miss for Intel in that area. So they're trading down today about 10.25% right now.
Intel is an interesting stock because they're quickly becoming not a dinosaur, but definitely a senior player in the chips. I've been kind of interested in seeing what was happening to them because now they're actually putting Windows on Qualcomm chips. So there's a whole new range of competition on there going on. Intel's going to feel that for a while.
Yeah, they are. And it's, they were kind of a favorite child there for a while, but they are definitely getting beat up this morning based on all those metrics. So if we go to the other tech side of the world, we go to Seagate. I don't know. I remember when Seagate was pretty much the only hard drive manufacturer in the world.
They were the gold standard for a long time.
They were. They kind of reported weaker than expected revenue for the third quarter. They earned 93 cents a share, but revenue missed by a little bit. Earnings beat by a little bit. They did raise its dividends and their buyback program. So at least there is some positive news there, but because of the other end of the spectrum, they're trading down about 2.75% this morning.
You are just not Mary Sunshine this morning so far, Phillip.
No, but let me switch to the financials. So it's a kind of a mix of two stories here. We have Capital One reported yesterday after the close, and Dave, they hit it out of the park. They beat earnings by $3 a share. They're expected to come in at about $3 a share. $2 a share. They came in at $5 a share.
Holy crud.
Yeah. And they beat on revenue also by over $500 million. So they really had a good quarter, and they're trading up today about 4.75%.
I was going to say they're toward the top of my big winner list, and they're one of the ones that I kind of watch because they're a heavy consumer bank, and that's a good indication of how the consumer business is going because they make their money off of the consumers.
That's right. And so let's look at the other end of that spectrum. We got American Express, and they missed by a little bit on earnings per share. Not by a lot, but they came in at $1.30. They're expected to be about $1.35. So a 5-cent miss there. Revenue, though, was a little bit better than expected, but that did not make stockholders and traders happy. They're down about 3.8% this morning before we get going.
That's kind of a tale of two companies, too, because Amex is toward the top of my big loser list. How do you have your revenue up and your profit go down? That's not a good sign for a company's management.
No, it's not, because you would expect during what's happening right now for cost cutting to be one of the prominent things they're trying to do. So a miss there for them. So let's go to the toy industry. We have Mattel reporting, and they beat expectations on both the top and bottom line, which was good for them.
Cool.
They beat significantly by about 55 cents a share, and revenue came in better than expected too by about $200 million. So that was, Mattel, they've struggled over the years. They would be on your big winner list if they trade anywhere there, Dave. They're up a little over 7% this morning.
Cool. You and I have always talked about the toy industry as being kind of a zero-sum game. If Mattel is up, Hasbro's down. If Hasbro's up, Mattel is down. I saw the announcement this morning. Mattel is introducing an Elton John Barbie for the Christmas shopping season.
I heard that too. Yeah, exactly. At $50.
Barbies ain't cheap by any measure, so good luck to them for the Christmas season and the Elton John Barbie. I kind of shook my head at that.
All right, Dave. The last one I have for you is Bloomin' Brands. And so they came in and reported a smaller than expected loss, so that was good. Revenue was up compared to where they expected it to be. So they had some good indications there, and they're actually trading up today 1.25%. All right,
I've got a mixed bag, and we got a mixed bag as far as early indications this morning are concerned too. Resetting the table here, it was an up day yesterday on Wall Street. There was some optimism to be had at the end of the day. 153 points up on the Dow, 21 points up on NASDAQ, and about 18 point up in the S&P, which is a pretty good day for the three indexes all being green at once. 45 minutes before we start trading this morning, Phillip, how do the indications look so far?
Hey, they are moving up, not as high as they had been, but they're still green. We've got the Dow 30 up about 1/3%, the S&P 500 up about 1/3%, and the NASDAQ up 1/4%. None of those numbers are going to get us to a week of green ink. So they need to do better than that to put us in a green position for the week. On the other side of the coin, on the commodity side, we got silver up 0.7, gold up almost 0.5%. Crude oil, not where we'd like it to be, up 1/4% to $40.74 a barrel.
At least it's holding above 40 anyway. Overseas markets, green ink in Asia, modestly anyway at the close early this morning. Europe evidently likes what they're hearing on our futures because both Great Britain and Germany are up by over 1% midway through their trading day. Phillip, helping me take advantage of these green ink days always takes a challenge, but not taking too many risks at the same time. How do I find you to analyze my portfolio?
Then give us a call at 863-382-0037. That's right. The only thing folks can control in their portfolio is the amount of risk. That's why we developed the financial x-ray to really measure how much risk you have in your portfolio. Give us a call, 863-382-0037. Go to our website, statlerfinancial.com. There's a link there where you can schedule a phone call or an appointment. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730.
And streamed all the time at HighlandsNewsTalk730am.com. Phillip, thank you so much. You have a marvelous weekend, and we'll catch you Monday, all right?
All right, sounds good, Dave. You also looking forward to our conversation on Monday.
Thank you. Take care, my friend. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
So, folks, I know we had a few technical difficulties today. We had to kind of stream Dave in via the cell phone, but hopefully you gained some information. A lot of earnings today, and next week a lot of macro stuff. So remember, there's only one thing you can control, and that's the risk in your portfolio. Call me now. Let's get an idea of how much risk you have in your portfolio. Give us a call at 863-382-0037 or visit my website, statlerfinancial.com, where we have a link where you can schedule a call or schedule a visit. Up to you. Have a great weekend. I look forward to speaking to you again on Monday.